where are markets going? So I want to take a look at, we're going to kind of split this up between some looks at valuation issues in the market, and for the second part, look at some planning issues, especially as it relates to tax reform. Rob talked about the fact that forecasting can be tough. Another very smart man came up with the same philosophy. His name was Yogi Berra. And he said, the future ain't what it used to be. And he also said, it's deja vu all over again. Now, I know when you look at these things, they seem really silly, but they start to make some sense when you look at them really carefully. So I want to talk to you about a report. We took a look at a report put out by the National Bureau of Economic Research. And it's 200 pages long. If you have trouble sleeping, we can send you a copy. And it goes, so these guys took a look at returns of 4 different asset classes over 16 different countries from 1870 to 2015. And the asset categories were T-bills, bonds, equities, and housing. Not housing in the sense of a single-family home housing, rental housing, because that's how far back they had the data. So we're going to take a look at sort of what these results are. I want you to imagine that you retired in 1870, and you were 65 years old. And the reason why, so we can take a look at what the returns are. Now, the good news about retiring in 1870 and still being here is that you're 213 years old. And if you were a golfer, you should have been able to shoot your age for at least the last century. So there are positives to being that old. When we look at the returns, this is the nominal returns. The T-bills were about 4.6%, very low risk. Bonds, better returns, but significantly more risk. Real estate, much better returns, 5% a year better than bonds, but not a lot of extra risk. And then stocks, similar in returns to real estate and significantly more risk. Same return, significantly more risk. Now, it sort of makes it seem like a no-brainer where you have to then obviously go for real estate as the asset class. If the return's over, well, mind you, you're not going to be living for 150 years or 200 years, but still, notwithstanding. But there's a reason why real estate is or has a lower risk level or a lower level of volatility, because in this case, risk refers to volatility. How much does the price rise and fall over any cycle? Well, one of the problems with real estate is if the market drops significantly, selling it is really difficult. And even if you want to sell it, the transaction costs, in our province, property purchase tax issues, means people do not cycle over. So they grin and bear it. From a behavioral finance perspective, they behave better when they own real estate than when they own stocks. So that has a lot to do with the volatility issue as well. So let's take a look at what might happen as we move forward. This is the impact of the CaseShiller price earnings index over the last roughly 130 years. So Robert Shiller came up with this formula looking at price earnings ratios on average going back 10 years. And you see these peaks, and then you see what happens after the peaks. And I guess the question mark is, well, are we at another peak? You could certainly make the case, since where we are now is higher than it was in 1929. And the only time it was lower was during the dot-com era. So what I decided to do was to take a look, all right, how do assets perform after these peaks? So remember, we know that stocks had an average return of 10%. Adjusted for inflation, stocks have had an average return of around 6.5% over the last 150 years. But how do they do along with bonds after these peaks? So when we take a look at 1929, basically a 0% return. And as we go through each of these periods of time, the average return for each of these is about 0.3%. The objective in a balanced portfolio, in order for you to achieve the objectives you want in terms of inflation-protected growth and the ability to draw income out of your capital, you need a 4% long-term real rate of return. This is a probability exercise. What we're looking at here is once we choose to invest in long-only strategies, when markets are this expensive, we should expect in the next 5 years to get a 0% return. Think of it as going to a casino. Now, when you go to a casino, who would you rather be? You or the casino? So in most cases, you don't really have a choice. But every game, of course, that you play, the odds are stacked against you. So if you already knew that, when it came to investing, what would you do differently in order to avoid this type of outcome? No real return for 5 years. It's like this poor kitten trying to tread water, not really going anywhere. So the asset allocation model, for those of you that do work with us, looks something like this. It's about 20% in real estate, 40% in equity. Fixed income is about just over a third, and alternatives. Made up of Canadian and U.S. real estate, Canadian foreign private and public equities, global and bonds, mortgages, and private debt, global, U.S. and Canadian, and hedge funds and precious metals. This model comes from taking a look at best practices from a number of the best Canadian pension plans, and organizations such as Yale and Harvard all use some variation of this type of asset allocation. So we don't have, for our own portfolios, records going back to 1929. I know some of you think I've been in the business a while, but not quite that long. So, but we can go back to the last two market bubbles, 2000 and 2008, and take a look. So our average client return, this is net of inflation and fees, in 2000 was 5% for the ensuing 5 years against -2 for the marketplace, and 3% in 2008 versus 0. So the difference was 5.1% in real terms, and remember, we're trying to hit a target of 4%. So in this environment, asset allocation has a lot to do with outcomes. So let's take a look at less risk and more return. So we're going to look at two different examples, one from the equity side, one from the real estate side. So on the equity side, one of the strategies we've been doing for quite a few years is covered writing. It's where we essentially are buying shares in companies we want to have, but at the same time hedging the downside by selling options, either puts or calls on them. What you're looking at here in the blue is what's called the put right index. This is an index made up of all of the stocks of the S&P 500, and essentially puts or options are being written against them, against the market itself. And the difference is that while the return is not hugely different, this is over a 20-year time frame through bull markets and bear markets, the result is a modest 13% improvement over just buying stocks, just buying an ETF, the index, but with 30% less risk. The difference in bear markets is that gap, which is only 0.5% over the entire cycle, is closer to 5 to 10% a year in bear markets. So covered writing strategies outperform in bear markets and generally underperform in bull markets. Now, we've had a covered writing pool called the Tactical Fund. This is a Canadian fund, and what you're looking at is a graph comparing its performance since 2010, which has primarily been a bull market. And that's the difference between the tactical fund's net return and the index return each year, 3% a year difference, a cumulative difference of 74%, and with 14% less risk. So this is a way of being able to stay in the equity markets even if you feel that they're working against you. You don't have to think about market timing. You can look at this as a different kind of strategy or tactic, if you will, to reduce risk. Another example of this is about 3 years ago, we invested in the Harbour Towers Hotel in Victoria. And as you know, it's got a great location. We acquired it in 2015 for $23 million, 196 rooms. And when we bought it, it had an income of 6.5%, which is actually pretty reasonable. But if you're in the hotel business, you're definitely taking greater risk. So even though we were able to increase the income to almost 9%, the fact is it's still a hotel. And the only reason we actually wanted to buy it was because we would have the right to convert it to apartments, to a multifamily residential building, which is the lowest risk type of real estate generally that you can acquire. So we did that. That's occurring as we speak. It'll be 219 rental units. Projected cost will be $56 million with the upgrades that are going to be completed, and it'll have a value of about $67 million when finished, which is an internal rate of return of about 17% per year. So it's not, we're in an environment which Rob was talking about. Interest rates rising makes it a tough market for fixed income. Cap rates are going to get punished as a result of higher interest rates whenever they do occur, and they're slowly occurring now. And ultimately, we've just taken a look at how expensive equity markets are. So there's no free lunch here. So the only way we're going to get returns in this kind of a market, sort of like swimming upstream, is we're going to have to look where we can add value in every asset class that we're involved in.